Welcome to Value Vest Daily. If you were watching the markets on March 4th, 2026, you saw something absolutely wild happen. Bitcoin, which had kind of been treading water for a while, just suddenly erupted. It was this massive, nearly vertical move that left a whole lot of people scratching their heads and asking one simple question: what on earth just happened? Well, in this explainer, we're going to break it all down and get to the real reasons behind that unbelievable crypto surge. And when I say erupted, I really mean it. The price just shot up to a peak of $73,000. I mean, think about that. That's a jump of nearly 7% in a single day, a level it hadn't even touched in over a month. This wasn't some slow and steady climb, not at all. This was an explosion, an event that added billions and billions of dollars to Bitcoin's market cap in just a few hours. Just look at this chart. It really puts the whole move into perspective. You see, we go from $68,300 one minute to a high of $73,000 the next. That's a nearly $5,000 jump. So, what kind of forces are powerful enough to move a trillion-dollar asset that fast? Well, it turns out it wasn't just one thing. It was a perfect storm. All right, so to really get our heads around what happened, we're going to walk through this perfect storm, piece by piece. First, we'll look at the geopolitical situation. Then we'll dive into how Wall Street got involved. After that, we'll unpack the wild market mechanics of something called a squeeze. And finally, we'll ask the big question: what in the world happens next? Okay, so the first, and maybe the most immediate piece of this entire puzzle, starts with global conflict. What we saw were rising tensions in the Middle East, and that really acted as a powerful catalyst. It got investors everywhere to seriously rethink where they were putting their money to keep it safe. Now, what's so fascinating here is how this shows a classic, almost textbook market reaction. Initially, right when the news broke about military strikes, fear just took over. You know how it is. Panic sets in, risky things like crypto sold off. But then, the entire script flipped. As whispers of a potential de-escalation started to surface, the market didn't just recover. No, it rebounded with unbelievable force. And right here, this is the core logic behind that massive rebound. The market suddenly had this aha moment and remembered a key idea. Wars are incredibly expensive. And how do governments often pay for them? By printing more money, which, as we all know, just waters down the value of currencies like the dollar. So, when that fear kicks in, investors start scrambling for scarce assets. Things that can't just be created out of thin air. And with a hard cap of only 21 million Bitcoin that will ever exist, well, it fits that description perfectly. And this, right here, is the digital gold theory in action. It's the proof in the pudding. On that chaotic day, investors were running for cover, looking for a safe haven. And while traditional gold did its job, it climbed a very respectable 1.8%. Bitcoin just completely outperformed it, surging over 7%. It basically acted like a high-powered hedge against all that global uncertainty. So let's move on to the second major force here, because this is where we see how that geopolitical fear got amplified by what I can only describe as a fire hose of new money. While the whole world was glued to the news, Wall Street was very quietly buying the dip. Just look at this number: $1.1 billion. Let that sink in for a second. That is the net amount of new cash that flowed into spot Bitcoin ETFs. Those are the funds that hold actual Bitcoin and trade on regular stock exchanges in just the week leading up to the spike. This wasn't a trickle, folks. This was an absolute flood of institutional demand. So the really crucial question is, who is doing all this buying? And the answer is the big guys. We are talking about giants like BlackRock, whose ETF soaked up over $500 million in just 2 days. We're seeing pension funds, wealth managers get in on the action. And of course, you have corporate whales like MicroStrategy, who are just constantly adding more to their stash. This kind of systematic buying takes a huge amount of Bitcoin off the open market, which reduces the supply and helps create a much stronger price floor. Okay, so we've got a geopolitical catalyst, right? And we've got this massive wave of institutional buying. This steady demand from Wall Street created the perfect setup for what happened next. It basically turned what was already a strong rally into an explosive surge. It was like pouring gasoline on a fire. Now, to really understand this, we need to quickly talk about something called a short squeeze. So, what is it? Well, imagine you bet your friend that the price of something is going to go down. That's called shorting. But what if you're wrong? What if the price starts going up instead? Well, you start losing money fast. To stop the bleeding, you're forced to buy back the very thing you were betting against. And that forced buying creates a crazy feedback loop, pushing the price up even faster and trapping even more people who made the same bad bet. And the conditions leading up to March 4th were absolutely positively perfect for this. There was just widespread fear in the market. A ton of traders were shorting Bitcoin, expecting the price to tank because of all the war fears. It created this incredibly fragile situation. The whole market was basically a coiled spring, just wound up tighter than a drum, waiting for a trigger. And then, bang, that trigger got pulled. As the price started to tick up from all the institutional buying and the geopolitical news, the short squeeze began. Up to $500 million in those bearish bets were liquidated, just wiped out, gone. This forced a massive cascading wave of buying that poured fuel on the fire and was responsible for that sharp, nearly vertical part of the price spike you saw on the chart. So let's bring all of these pieces together. We've seen all the individual drivers, but the real story, the real magic, is how they all crashed into each other at the exact same time to create one single massive event. Look, this wasn't random. This was that perfect storm we talked about. You had investors using Bitcoin as a hedge against global conflict and inflation. At the exact same time, you had these institutional ETFs just sucking up supply from the market. This constant upward pressure then triggered a massive short squeeze that sent the price vertical. And all of this was happening against a backdrop of growing optimism about regulation, with new rules on the horizon giving long-term investors way more confidence to jump in. It was the convergence of everything, all at once. So the combination of all these factors perfectly explains the mechanics of that spike. We know why it happened, but it leaves us with the billion-dollar question that everyone in the market is asking right now. Was this a bull trap, a fake-out rally that sucks people in before the price falls again, or was this the start of a real sustainable recovery? The answer, well, it's likely going to depend on whether these powerful forces, especially all that new institutional money, are actually here to stay. And of course, just a quick reminder, this is not financial or tax advice. Please do your own research. Please subscribe, like, and share Value Vest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high risk/reward opportunities.